Imagine waking up tomorrow and discovering that the cost of your house, your car payment, your business loan, and even your favorite coffee shop are all affected by one decision made by a small group of people sitting in a quiet government building. No vote from you. No warning. Just one number moving slightly higher. The interest rate. A number that looks boring on a news headline. But behind that number is a machine powerful enough to slow down entire economies, destroy billions in wealth, and change how millions of people live. And the strange part? Sometimes, the biggest economic storms in history begin with a change smaller than 1%. To understand why, we need to go back to a simple idea. Money has a price. And that price is called interest. When you borrow money, interest is the cost of using someone else's money. When interest rates are low, borrowing feels easy. Businesses take loans. People buy houses. Investors chase bigger opportunities. The economy starts moving faster. It feels like everyone has discovered a secret shortcut. But there is a hidden problem. Cheap money can create a dangerous illusion. When borrowing becomes too easy, people often stop asking one important question. Can we actually afford this? Because when money is cheap, everyone looks richer. A company can borrow millions and expand. A person can buy a bigger home. An investor can pay higher prices for stocks. Everything rises. Until the music stops. Now imagine a central bank notices prices are rising too quickly. Food costs more. Rent climbs. Gas prices jump. Your paycheck buys less than before. This is inflation. So the central bank reaches for its most powerful tool. It raises interest rates. Sometimes by just 0.25%. A tiny move. Almost invisible. But the effects spread like a wave. Why? Because the entire financial system is connected. Think about a company planning to build a new factory. If borrowing money costs 3%, the project might make sense. But if borrowing suddenly costs 7%, the numbers change. The factory gets delayed. Workers are not hired. Suppliers lose orders. A decision made thousands of miles away suddenly reaches ordinary people. And housing shows the impact even faster. A mortgage is basically a long-term bet on interest rates. When rates rise, monthly payments increase. A family that could afford a $400,000 home last year might only afford a $300,000 home today. Not because they changed. Not because the house changed. Only because the price of money changed. This is where the system becomes almost ironic. Central banks raise rates to make life cheaper by slowing inflation. But the first thing many people feel is that life becomes more expensive. Higher loan payments. Lower business growth. More financial pressure. The cure can feel like the disease. And markets often react before the economy does. Investors are constantly trying to predict the future. When they hear interest rates may stay higher, they don't just think about today. They think about tomorrow's profits. That is why a small sentence from a central bank official can erase billions of dollars from stock markets in a single day. Not because money disappeared, but because expectations changed. The uncomfortable truth is that modern economies run on confidence. People spend because they believe tomorrow will be better. Companies invest because they believe customers will keep buying. Investors take risks because they believe growth will continue. Interest rates influence all of those beliefs. But here is the part most people miss. Central banks are not controlling the economy like a video game. They are trying to steer a massive ship through a storm. Move too slowly, and inflation can damage purchasing power. Move too aggressively, and they can push the economy into a recession. History has shown both outcomes. In the early 1980s, the United States dramatically raised interest rates to fight extreme inflation. The result? Inflation eventually fell. But unemployment surged, and many businesses struggled. Decades later, during periods of economic weakness, central banks often lowered rates to encourage spending and investment. The same tool. Completely different consequences. So when you hear that interest rates changed by a tiny amount, remember this. It is not just a number. It is a signal. A signal that changes decisions made by millions of people. Someone decides whether to buy a house. A company decides whether to hire workers. An investor decides whether to take a risk. All because of a percentage point. And maybe the strangest part of the entire system is this. The world's economy can be influenced by a number so small that most people ignore it. But that small number quietly decides who borrows, who invests, who grows, and who struggles. The question is not whether interest rates affect the world. They do. The real question is, when that tiny number moves again, who will be ready for the shock?